Chapter 19. Chapter 19 deals with accounting for income taxes. This does not mean that we're going to go into great detail of what's deductible, what's taxable, but what we're going to look at is the differences between what the IRS says and what GAAP says. This particular chapter is going to talk about the fundamentals of accounting for income taxes, some of the additional issues that are related to accounting for income taxes, the accounting for loss carrybacks and the loss carryforwards, and the presentation of deferred income taxes in our financial statements. This problem occurs because conceptually, corporations file their income tax returns using the guidelines that are developed by the Internal Revenue Service. These are the prescribed tax regulations and rules that change nearly every year to some degree. Pre-tax financial income is determined and reported according to generally accepted accounting principles. Now, when there are differences between those, and it's not unusual, there will be a difference between the income tax expense and the income tax that is paid in a given point in time. To really understand that, let's look at an illustration. So Chelsea Incorporated reported revenues of $130,000 and expenses of $60,000 in each of its first 3 years of operations. So for tax purposes, Chelsea reported the same expenses to the IRS in each of these years, but their taxable revenues were different. Their taxable revenues were $100,000 in 2017, $150,000 in 2018, and $140,000 in 2019. So we're going to look at what the effect is on the accounts of reporting different amounts of revenue for GAAP versus tax. So this particular illustration shows us the revenues and the expenses leading to $70,000 of pre-tax income, applied a 40% tax rate for $28,000 in income tax expense a year. However, due to the differences in GAAP and the IRS code, the revenues were different in the years than per GAAP. This resulted in changes to our taxable income. Taxable income was only $40,000 in 2017, resulting in a $16,000 income tax payable. However, in 2018, rather than $28,000, which is our income tax expense, we have a remission or a payable of $36,000. And in 2019, instead of $28,000, we need to remit $32,000. So this is a temporary difference. This is when there's a difference between the tax basis from one to another. This creates a deferred income tax, knowing that we have $28,000 of income tax expense in 2017, but we are only remitting $16,000. We have $12,000 in expense that we are not paying out in 2017. Thus, we know that we should need to pay that out at a later period of time. So the differences are accounted for in the financial statements, and these are those differences. So our expense was $12,000 more than our income tax payable in 2017. So we would increase the deferred tax liability by $12,000. Now in 2018, our expense is $8,000 less than the amount that we need to remit. So we would then reduce that liability by $8,000. And in 2019, by the $4,000. Now, where does this deferred tax liability get reported on the financial statements? This deferred tax liability exists on the liability section and the income tax payable. So the amount actually attributable to the income taxes is also going to be in the liability section. And the two of them will equate to the amount of the income tax expense. So sometimes these temporary differences are the result of the difference between a tax basis of an asset or a liability and its book value in the financial statements, and will result in taxable amounts or deductible amounts in future periods. Future taxable amounts are deferred tax liabilities, which represent the increase in taxes payable in future years as a result of a taxable temporary difference existing at the end of the current year. So if we think back, let's just flip ourselves back to this page here. So this year there is a temporary taxable difference, so of $12,000. We know that there's $12,000 that will need to be taxed in future years, but is actually related to this year because our expense is $28,000. So we have a liability of $12,000. That's going to occur at some point in the future. Now that we may also have a deferred tax asset, which is an increase in taxes that are refundable in future years as a result of a deductible temporary difference existing at the end of the current year. So let's look at future taxable amounts. So in Chelsea's situation, the only difference between the book basis and the tax basis of the assets and the liabilities relates to the accounts receivables that arose from revenue that was recognized for book purposes. Chelsea reports accounts receivables at $30,000 on December 31st, 2017. However, the receivables have a zero tax basis. Chelsea assumes that it will collect the accounts receivables and report that $30,000 collection as taxable revenues in the future tax returns. So what they do is they record a deferred tax liability. A deferred tax liability represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. So although we earned $28,000 in accrued revenue, we earned, I don't remember how much in accrued revenue, there was a $30,000 difference. That difference resulted in a $12,000 difference between our income tax expense and our income tax payable. However, because we will collect those funds in future periods, we'll have to remit taxes on them in future periods. Because it is in its first year of operations, Chelsea doesn't have anything in its deferred tax liability account at the beginning of the year. They compute their income tax expense for 2017 to be $28,000. $16,000 of it is a current tax expense, and then $12,000 is a deferred tax expense. So we make this entry at the end of 2017. We have total income tax expenses of $28,000 based off accrual accounting. We need to remit income taxes payable of $16,000. And then we have a deferred tax liability, taxes that we'll need to remit in future periods to the sum of $12,000 related to the year 2017. Now, at the end of 2018, we have income tax expense still of $28,000. We reduce our deferred tax liability by $8,000 and recognize the need to remit $36,000 of income taxes payable to the IRS. The end of 2019, we have an income tax expense still of $28,000. We have a reduction in our deferred tax liability of $4,000 to recognize income taxes payable to the IRS of $32,000. So at the end of 2019, this is what the deferred tax liability T account would look like. Here we have a basic presentation for representation of a reconciliation of the differences between our income tax payable and our deferred tax liabilities. And here we have the partial income statement. So let's look a little bit more, and we're going to do Starfleet. Now, they have one temporary difference at the end of 2017 that will reverse and cause taxable amounts of $55,000 in 2018, $60,000 in 2019, and $75,000 in 2020. Their pre-tax financial income for 2017 is $400,000, and their tax rate is 30%. There are no deferred taxes at the beginning of 2017. So first, we're going to compute the taxable income and the income tax payable for 2017. Prepare the journal entry to record the income tax expense, deferred income taxes, and income taxes payable for 2017. So our current year financial income is $400,000. We have a temporary difference related to 2018 of $55,000, 2019 $60,000, and 2020 $75,000. So that is a total of $190,000 difference in 2017. But this is only temporary, because in 2018, 19, and 20, those are going to be taxable amounts. This gives us taxable income in 2017 of $210,000. We apply that 30% tax rate to it, then we would have income tax payable of $63,000. We would have that 30% attributable to each of those different years' taxable amounts, giving us additional taxable amounts of $57,000. We have a deferred tax liability of $57,000. We know that we have income tax payable of $63,000 for this year, which would be an income tax expense of $120,000. Now this is plug, but you could also calculate that yourself. If you were to take financial income and multiply that by 30%, you would receive $120,000. So the question is, are tax liabilities real liabilities? Some analysts will dismiss them when looking at the financial strength of the company. But FASB indicates that the deferred tax liability meets the definition of a liability established by the Statement of Financial Accounting Concepts number 6, Elements of Financial Statements, because it results from a past transaction, it is a present obligation, and it does represent a future sacrifice. So let's take another look here at future deductible amounts. So during 2017, Cunningham estimated its warranty costs related to the sale of microwave ovens to be $500,000, paid evenly over the next 2 years. For book purposes, in 2017, Cunningham reported warranty expense and a related estimated liability for warranties of $500,000 in its financial statements. For tax purposes, the warranty tax deduction is not allowed until it's actually paid. A lot of the IRS prescription is related to closer to cash than accrual, but really it's very much a hybrid. So the reversal of the temporary difference would be that there's an expectation of future deductible amounts. We would have lower taxable income than pre-tax financial income in future years when we pay the warranty liability. We would then be allowed to report it as a deductible amount for tax purposes. So we report this future tax benefit on the balance sheet as a deferred tax asset. So a deferred tax asset represents increases in amounts that should be refunded to us in future periods as a result of a difference in the current period. It results from a past transaction. It gives rise to probable future benefit, and the entity controls access to those benefits. The basic calculation of a deferred tax asset would be book basis minus tax basis, giving us a cumulative temporary difference. We take that cumulative temporary difference and we multiply that by the tax rate. Let's look a little closer at a deferred tax asset. So Hunt Company has revenues of $900,000 for 2017 and 18. Has operating expenses of $400,000 for each of these years. In addition, they accrue a loss on a related liability of $50,000 for financial reporting purposes because of a pending litigation. Hunt can't deduct this amount for tax purposes until it actually pays that amount, which is expected to happen in 2018. As a result, a deductible amount will occur in 2018 when they settle the liability, but according to GAAP, because it's a result of something that happened in 2017, it attaches to that particular year's financial information. So this causes taxable income to be lower than pre-tax financial information. Let's look at the next 2 years. GAAP says we'll have $180,000 in 2018 of income tax expense. However, because we can't take that litigation loss yet, tax reporting says that we would have income tax payable $200,000. Now in 2018, GAAP says we would have $200,000 in income tax expenses. But because we will remit the $50,000 in 2018, tax reporting says we would have $180,000 in income taxes payable. So Hunt can compute the deferred taxes by preparing a schedule that indicates the future deductible amounts due to deductible temporary differences. Now let's assume that 2017 is the first year of operations and the income tax payable is $200,000. We need to compute the income tax expense. So we have, for the entry, we would have $180,000 of income tax expense. We then would have deferred tax assets of $20,000 to account for the full income tax payable of $200,000. Now, because this is a temporary difference, in 2018, we would have income tax expenses of $200,000. We would reduce that deferred tax asset by $20,000, and we would represent income taxes payable to be remitted $180,000. So for the financial statements, you would see on our income statement, we would have an income tax expense representing $200,000 of current, $20,000 deferred, for a total of $180,000 for 2017. The end of 2018, our deferred tax asset accounts would be represented here, showing the recognition of it in 2017 and then the realization of it in 2018. Let's look at Columbia. Has a temporary difference at the end of 2017 that will reverse and cause deductible amounts of $50,000 in 2018, $65,000 in 2019, and $40,000 in 2020. Their pre-tax financial income for 2017 is $200,000, and their tax rate is 34% for all years. There are no deferred taxes at the beginning of 2017, and Columbia expects to be profitable in the future. So we're going to compute the taxable income and the income tax payable for 2017, and then prepare the journal entry to record income tax expenses, deferred income taxes, and income taxes payables for 2017. So we have financial income of $200,000 in 2017. Now we have a difference with $50,000 in 2018, $65,000 in 2019, and $40,000 in 2020, giving us a total temporary tax difference of $155,000. This means that we have in the current year taxable income of $355,000, $155,000 of which in future years we will not be taxed on. Our income tax payable will be $120,000. We'll have deferred tax assets of $52,700. That's the total of the 34% attributed to each of those years, and a total income tax expense of $68,000. Deferred tax assets should be reduced by valuation accounts if it's more than likely than not that some portion or all of those deferred tax assets might not be realized. We need to evaluate all the evidence, both positive and negative, and recognize the probability of non-recognition. So let's look at that using Callaway Corp., who has a deferred tax asset balance of $150,000 at the end of 2017 due to a single cumulative temporary difference of $375,000. Now, at the end of 2018, the same temporary difference has increased to a cumulative amount of $500,000. Taxable income for 2018 is $850,000. The tax rate is 40% for all the years, and there was no valuation account in existence at the end of 2017. assuming that it's more likely than not that $30,000 of the deferred tax asset will not be realized, we need to prepare journal entries for 2018. So first we have the 2017, where we had taxable income of $375,000, an income tax payable of $150,000. Now in 2018, we have income tax expenses of $290,000. We have deferred tax assets of $50,000. Total income tax payables of $340,000. We recognize that $30,000 of that probably is not going to be recognized. So we take income tax expense of $30,000 and we post a credit to an allowance for our deferred tax asset of $30,000. This is a snippet of the balance sheet representation of how a deferred tax asset with a valuation account attached would be reported. Now remember that this deferred tax assets and these deferred tax liabilities are the result of temporary differences. Temporary differences are something that happens this year that is going to cause either an increase or a decrease in the amount of income taxes payable, not the amount of income tax expense, but the income taxes payable in future years. Now, if there is a permanent difference, there would be no deferred tax consequences. Items are not recognized for accounting purposes, but for tax purposes. And sometimes things that can happen is over the years that the tax rate can change. So with that, we could have a change in the deferred tax asset or the deferred tax liability that we expect. For example, if our tax rate changes and we believe that to be a permanent difference, then we may not be able to collect as much as we had expected.